The screens are dark. The ticker tape has stopped moving. The trading floors in New York and London are empty, swept clean by the janitors who have no idea that the building they are cleaning is technically a crime scene. To the average person, today is Thursday, January 1st, 2026. It is a holiday. The banks are closed, the markets are closed. The world is nursing a hangover, watching college football, and believing that the price of silver is exactly where it was when the closing bell rang yesterday afternoon, 78:50. But they are wrong. We are writing this report to document a phenomenon that has not occurred in the global financial system since the collapse of the London gold pool in 1968. We are documenting the birth of a bifurcated reality. The market never closed. While you were sleeping, while the official exchanges were paused for the holiday, a gray market emerged in the shadows of the global supply chain. And in this gray market, the price of silver is not $78.50. It is not even close. We have received confirmed intelligence from private brokerage desks in Dubai, Singapore, and Zurich that purely physical transactions, cash for immediate title transfer of 1,000-ounce bars, have been executing all night. The price? $112. Do you understand the gravity of what we are telling you? Right now, there's a $33.50 spread between the official price that will show up on your brokerage app when you log in and the real price that industry titans are paying to secure metal before the sun rises on January 2nd. This is not a premium. This is not a dealer markup. This is a fundamental fracture in the mechanism of price discovery. The paper market is frozen in the past, stuck in 2025. The physical market has accelerated into the future, violently pricing in the Basel IV regulations and the Chinese export bans that became law at the stroke of midnight. For 50 years, the illusion of the silver market depended on one thing: convergence. The paper price and the physical price had to meet. If they drifted apart, arbitrage traders would step in, buy the cheap paper, stand for delivery, and sell the expensive metal, bringing the prices back together. But today, on this quiet New Year's Day, the convergence has broken. The arbitrage traders are paralyzed. They see the $33.50 gap. It is the opportunity of a lifetime, but they cannot execute the trade. Why? Because they know what the banks know. They know what Samsung knows. They know that if they buy the paper contract at $78.50 when the market opens tomorrow, there will be no delivery. The vault is empty. The paper contract is no longer a claim on metal. It is a claim on a cash settlement that hasn't been announced yet. You are living through the phantom session. The most important trading day of the century is happening right now, on a day when the markets are supposedly closed. The wealth of the world is being repriced in the dark. The ownership of the strategic reserves is changing hands in private deals that will never appear on a public ledger. And the vast majority of investors are completely oblivious. They are looking at the closing price of 2025 and feeling safe. They do not realize that they are holding a ticket to a show that has already been canceled. When the opening bell rings tomorrow morning, Friday, January 2nd, the violence of the repricing will shock the world. The chart will not tick up. It will likely gap straight to the reality of the gray market. The $78.50 price is a ghost. It is a memory of a system that died at midnight. To understand why the market has split in two, we have to look at the dealer's dilemma that is playing out across the globe right now. Usually, a holiday is a break. The bullion dealers, the wholesalers, and the refiners take a breath. They hedge their inventory on the futures market, lock the doors, and wait for the open. But today, the phones at the major wholesale trading desks are melting down. Imagine you are a major bullion dealer in Texas or New York. You're sitting on an inventory of Silver Eagles and 100-ounce bars that you bought last week. Your hedging software, which is tied to the COMEX spot price, tells you that your inventory is worth $78.50 an ounce. But your phone is ringing. It is a procurement officer from a mid-tier electronics manufacturer in Taiwan. He is not asking for a quote. He's screaming for product. He's offering you $105 an ounce for everything you have in the vault, provided you can ship it today. What do? If you sell to him at $105, you make a massive profit relative to the paper price. But you also realize that something terrifying. You cannot replace the metal. If you sell your inventory, you are naked. You have cash, but you have no silver, and you know that when you try to restock next week, the wholesalers will be sold out. The refineries in China, as we established in previous reports, have closed the export gate. The COMEX is empty. So the dealers are doing something they almost never do. They are hoarding. Go to the websites of the top 5 online bullion dealers right now. Don't just look at the price. Look at the status. Notify me. Out of stock. Shipping delayed 4 to 6 weeks. Or look at the spread. Some dealers are showing a buy price of $80, but a sell price, what they will pay you, of $90. The bid is higher than the ask of the paper market. This is the definition of a broken market. The two prices are now visible to anyone paying attention. The zombie price, $78.50. This is the closing price of the 2025 futures contract. It serves only one purpose now. It is the number the banks will use to calculate your cash settlement when they default on you tomorrow. It is a tool of theft. The survival price, $112. This is the clearing price for physical metal in the gray market. This is what it actually costs to pry silver out of the hands of a holder who knows the truth. The reason the market never closed is that the demand for physical silver does not respect bank holidays. The industrial assembly lines do not stop. The solar panel factories in Jiangsu do not stop. They are burning through silver every hour. And right now, on January 1st, they are realizing that the supply chain has snapped. The disconnect has turned into a canyon. On one side, you have the paper investors, calm and oblivious. On the other side, you have the physical buyers, in a state of absolute panic, bidding up the price in private transactions to secure the last scraps of inventory. This is why tomorrow, January 2nd, is Judgment Day. When the comics opens, the zombie price has to face the survival price. The banks will try to open the market at $78.50 to protect their short positions. But the physical buyers will step in and say, I will buy everything you have at $80, at $90, at $100. The banks cannot defend the $78.50 level because they have no metal to sell. They cannot flood the market with paper because the Basel IV rules, which we will cover just after a minute, now penalize them for doing so. They are trapped between a regulatory rock and a physical hard place. The dam holds back the water only as long as the concrete holds. The concrete cracked at midnight. The water is leaking through the gray market. Tomorrow, the dam collapses. We need to talk about the invisible line that the world crossed at the stroke of midnight. While the fireworks were going off and the champagne was popping, the global banking system underwent a structural change that makes the old manipulation game mathematically impossible. Basel IV is now live. For years, this was just a theory. It was a deadline in the distant future. The banks lobbied against it. They asked for extensions. They tried to water it down, but the regulators in Switzerland held firm. As of January 1st, 2026, the net stable funding ratio, NSFR, is the law of the land. Here is why this changes everything for the price of silver today. Under the old regime, up until yesterday, bullion banks could hold massive unallocated short positions. They could sell paper silver they didn't have, and they could count the unallocated liabilities as stable funding. It cost them almost nothing to suppress the price. It was a free lunch. Today, the lunch is over. The bill has arrived. Under the new NSFR rules, an unallocated gold or silver position is viewed as a high-risk liability. It requires 85% required stable funding, RSF. This means that for every $100 million of paper silver a bank sells to suppress the price, they must now hold $85 million of Tier 1 capital, cash or sovereign bonds, against it. Do the math. The cost of manipulation just went from near zero to billions of dollars overnight. The trading desks at JP Morgan, HSBC, and Citi are looking at their books this morning in horror. They are sitting on short positions that were profitable yesterday but are capital destructive today. They have two choices when the market opens tomorrow. Post the capital. Tie up billions of dollars in dead cash to maintain a short position in a rising market. Their shareholders will revolt. Close the position. Buy back the short contracts immediately to get the liability off the books. Option 2 is the only viable business decision. But to close a short position, you have to buy. This is the setup for the super spike. The banks are not just facing physical shortages from the China dealer situation. They are facing a regulatory gun to the head that forces them to become net buyers of the very asset they have spent decades suppressing. And they have to do it now. They cannot wait. Every day they hold these positions in 2026, they are in violation of the new capital ratios. This is why this gray market price is 112. The insiders know that the biggest short covering rally in history is about to begin. They are front-running the banks. They are buying the physical metal because they know the banks will need it to cover their tracks. But remember the China lockout from our previous reports? The metal the banks need is trapped behind the Great Wall. So the banks are forced to buy back paper contracts. They will have to bid the futures price up to match the physical reality. They will have to close the gap. The two prices cannot exist forever. One of them has to win. And paper cannot beat physics. Paper cannot beat a regulatory mandate. When the sun rises on January 2nd, the banks will enter the market not as predators, but as desperate prey. They will be forced to bid against the industrial giants, against the sovereign wealth funds, and against the gray market. The $78.50 price is the before picture. January the 2nd reveals the after, and the damage will be total. We have established that the market has split. We have established that the banks are trapped. Now we must discuss the weapon they will use to try and cut their way out of this trap when the sun rises tomorrow. It is a weapon that is already loaded, aimed, and pointing directly at your brokerage account. It is called involuntary liquidation. While you're enjoying your New Year's Day, the legal departments of the major bullion banks and ETF custodians are likely drafting the force majeure market notices that will go out on Friday morning. Here's the scenario that the 3350 spread guarantees. Tomorrow, when the COMEX opens, the banks cannot allow the paper price to rise to meet the physical price of 112. If they did, their short positions would blow up, their capital ratios under Basel Furter would implode, and they would be insolvent by noon. So they will keep the paper price capped. They might let it rise to $80 or $85, but they will defend the $90 line with everything they have. But this creates a paradox. If the paper price is $85 and the real price is $112, every rational investor will try to stand for delivery. They will buy the paper contract and demand the metal so they can flip it for a risk-free $27 profit. The banks know this run on the vault is coming. And since they don't have the metal, because China locked it out, they have to stop you from asking for it. This is where Part 4 gets ugly. We predict that tomorrow, January 2nd, the exchanges will announce a cash settlement protocol. They will state that due to extraordinary logistical constraints and market irregularities, physical delivery is suspended. If you hold a contract or shares in a trust, they will not give you the silver. Instead, they will close your position and put cash in your account. But here is the theft. They will pay you the zombie price, 85, not the survival price, 112. They will force you out of the market at the manipulated low price. You will look at your account and see dollars. You might even see a profit on paper. But when you try to take those dollars and buy actual physical silver, you will find that the price is $112, $120, or simply unavailable. You are being evicted from the asset class. The banks are effectively saying, we cannot honor the contract, so we are canceling it. Here's your refund. Good luck. This is the soft default. It allows the banks to survive Basel IV by wiping their short liabilities off the books, but it does so by sacrificing the retail investor. The two prices are not just a curiosity, they are a mechanism of wealth transfer. The insiders are buying the metal at $112 in the gray market, Part 5, while you are being cashed out at $85 in the paper market. By the time you realize what has happened, by the time the email hits your inbox tomorrow morning, the physical window will be nailed shut. You will be holding fiat currency in a hyperinflationary event for hard assets. While the retail investor is being prepped for the slaughterhouse of cash settlement, the gray market we identified in Part 1 is buzzing with activity. Who is paying $112 an ounce for silver on a holiday? Who is desperate enough to pay a 40% premium over the closing price? It isn't the speculators, it isn't the coin collectors, it is the industrial titans. We have to talk about the panic of the procurement officers. For the last decade, companies like Samsung, Tesla, Apple, and Raytheon operated on a just-in-time delivery model. They believed the lie. They believed that the COMEX was a bottomless pit of silver. They believed that if they needed 5 million ounces for a new solar array or a battery line, they could just call London and get it. But today, on January 1st, 2026, the phone lines to London are dead. The China lockout means the supply chain is broken. These companies employ supply chain analysts who are far smarter than Wall Street economists. They see the Basel IV rules, they see the empty vaults, and they know that without silver, their factories stop. You cannot build a solid-state battery without silver. You cannot build a Tomahawk missile guidance chip without silver. It is not a financial option. It is a physical requirement. So, right now, behind the scenes, a massive shadow bid is swallowing the world's remaining inventory. We are receiving reports of direct offtake deals being signed on this holiday. Tech giants are bypassing the COMEX entirely. They are calling their refineries in Switzerland and the miners in Mexico directly. They are saying, we don't care what the COMEX price is. We don't care about the $78.50 on the screen. We will pay you $110. We will pay you $115. Just give us the metal. This is why the market is split. The paper price is for the banks and the retail victims. The real price is for the industrial giants fighting for survival. The industrial whales are eating the plankton before the market even opens. They are draining the floating supply that usually sits in the vaults of dealers and wholesalers. This means that when you try to buy silver tomorrow, you won't just be competing with other investors. You will be competing with a trillion-dollar tech company that needs the metal to stay in business, and they have deeper pockets than you. The ghost inventory is gone. The industry has realized that just in time has become not in time, and they are panic buying the float. This leads us to the final nail in the coffin of the paper market, the group that controls the tap. We have the banks defaulting. We have the industry panic buying. But there is one final player that determines the fate of the price on January 2nd: the miners. For 40 years, the primary silver miners have been the indentured servants of the bullion banks. They dug the ore, took the risk, and sold their product at whatever rigged price the COMEX dictated. If the price was smashed to $20, they starved. If it was smashed to $15, they went bankrupt. But today, the miners' shackles have fallen off. Intelligence from inside the major mining conglomerates in South America and Australia indicates that a seller's strike is effectively underway. Put yourself in the shoes of a mining CEO on this New Year's Day. You see two prices on your screen. Price A, the COMEX Dutch London price of $78.50. Price B, the shadow bid from Samsung, Tesla, China of $112. Where are you going to ship your metal? Are you going to send it to the COMEX so JP Morgan can use it to short the market against you? Or are you going to send it to the industrial buyer who is offering you a 40% premium? The answer is obvious. We are witnessing a supply diversion. The ships that were supposed to sail for London and New York are being rerouted. The metal is flowing to the highest bidder. This means that the COMEX is about to become a zombie exchange. It will continue to trade paper contracts. The lights will stay on, the computers will hum, but no new metal will enter the vault. The pipeline to the west has been cut. This is the ultimate nightmare for the banks. They are facing a short squeeze, Basel IV, a demand spike, industry, and now a total supply cutoff, miners. They are trying to hold back the ocean with a piece of paper. When the market opens tomorrow, the miners will not be selling. The dealers will not be selling. The industry will be buying. The banks will be the only sellers left. And they will be selling something they do not have. The two prices will eventually merge, but not because the physical price comes down. They will merge because the paper market breaks, defaults, and ceases to be relevant. The only price that matters is the price to get metal in your hand. We have arrived at the moment of kinetic release. This is the chapter where the laws of physics take revenge on the laws of financial manipulation. In the trading world, they call it a short squeeze. But what is coming when the opening bell rings tomorrow morning is something far more violent. It is a gamma recoil. Imagine holding a beach ball underwater. You push it down with all your strength. You use every muscle to keep it submerged. That is what the Western banks have been doing for 40 years. They have spent billions in leverage to hold the price of silver down against the buoyant force of a global shortage. But at midnight last night, Basel IV drained the water out of the pool. When the markets fully reopen tomorrow, January 2nd, the banks are going to lose their grip. Here is the math that terrifies the risk desks at JP Morgan and Citibank. To suppress the price, the banks have to be net short. They have to sell contracts they don't have. As the price bounces off the bottom, driven by the industrial panic bid, Part 5, and the lack of new supply from miners, Part 6, it ticks up. $80, $85.90. The banks are instantly underwater. Their losses aren't linear. They are exponential. And here's the trap they built for themselves. To stop the bleeding, they must buy. But who are they buying from? They can't buy from the miners. The miners have sent their metal to Shanghai. They can't buy from the retail public. The dealers have locked the doors. They can't buy from the East. The East has closed the export gate. This creates a gamma squeeze. As the price rises, the market makers who sold put options to the hedge funds are forced by their own risk models to buy futures contracts to hedge their exposure. They become forced buyers in a market with zero sellers. They will be chasing a ghost. The high-frequency trading algorithms that smashed the price yesterday are programmed to flip. Once silver crosses the key technical resistance levels, likely reclaiming the $90 level within minutes of the open, the sell bots shut off and the buy bots turn on. But this time, they will be bidding into a vacuum. We are predicting a gap-up event on Friday morning. The price won't drift up politely, it will teleport. You might go to bed seeing silver at $78.50 and wake up to see the first trade execution at $110. The Western banks tried to create a technical breakdown to save themselves from Basel IV. Instead, they have loaded the slingshot for the greatest technical breakout of the decade. The crash was the pullback. The release is next. And the target is no longer the old high. The momentum from this recoil has the mathematical energy to push us straight through to numbers that sound ridiculous today but will look cheap next week. The banks built a trap, walked inside, and handed the key to China. Now, the spring is uncoiling. We have reached the end of this investigation. We have analyzed the two prices. We have exposed the China lockout. We have tracked the miner revolt and the industrial panic. The yellow tape has been wrapped around the crime scene. The evidence is conclusive. The official price you see on your screen right now, that $78.50, is not a market price. It is a memorial. It is the timestamp of the exact moment the Western financial system died. The price action you're seeing, or rather the lack of it on this holiday, is the calm before the reset. It is a desperate attempt by a cornered cartel to hide the reality of the empty vault for one last day, hoping they can settle your account in cash before you realize what you have lost. Now, the only variable left in this equation is you. You are standing on the tracks of history. For 50 years, the silver market has been a rigged casino where the house always wins. They printed paper to suppress the price. They convinced you that an ounce of silver was worth $20, then $30, then $50. But while you celebrated the new year, the casino went bankrupt. The house has been cleaned out by a player bigger than them. The trap is set. The algorithm is live. The banks are counting on your ignorance. They're counting on you looking at your phone, seeing the zombie price, and thinking everything is normal. They want you to accept the cash settlement. They want you to sell your future to save their present. Do not give them that satisfaction. Here is your final briefing for the start of 2026. 1. Ignore the screen. The price you see on the COMEX is a phantom price. It is the price of a paper promise that is currently being defaulted on. It is not the price of metal. If you sell at that price, you're donating your wealth to the enemy. 2. Watch the spread. The signal is not the spot price. It is the disconnect. If spot is $78, but you can't buy an ounce for less than 112, of course, the price is $112. The disconnect is the market screaming that the paper era is over. 3. Hold the line. The moment the markets open tomorrow, the moment the Basel IV rules force the banks to cover, the gamma squeeze begins. The transfer of wealth from those who hold paper to those who hold metal will be the largest in history. We have the intel. We see the data. The silver bomb has been detonated. The shockwave hasn't hit the mainstream news yet, but it will. You have been warned. The vault is empty. The East has the metal. The West has the debt. And the only thing standing between the banks and total collapse is their ability to trick you one last time. Secure your stack. Ignore the noise. Let them burn in the trap they built for you. Subscribe to the channel. Turn on the notifications. We will be live when the markets reopen to track the explosion. The heist is over. The panic is next. Class dismissed.